Hello, hope you good. Hope you good. Hello, 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 hello. Hope you guys are good. Today, I'm going to be doing a review of what happened within the course of today. This is going to be an interesting one. Bear in mind, we're going to be using the same text. We're going to be using the same types of structure that we spoke about yesterday, and we're just going to see what currently transpired today. Okay, so today is the 30th of January 2024. And I wanted to look at it from the 4 hour time frame. First things first, we just get to understand what has been happening in the whole time frame. So currently we've had a consolidation. We've broken out of these highs and lows, all right? So currently we've broken down this low and we've been going down. So that means the order flow at the moment on the 4 hour time frame has been bearish, okay? Now, another thing you have to look into is the mitigation points. So the first mitigation point that we can look into is that we tapped into this supply or demand. All right. This demand right here is the demand that price mitigated before leaving and looking for higher highs. Okay. And remember on the day before, if you haven't watched the day before, please have a look and see what I said, that price is going to mitigate this OB right here, this bearish order block, and also it's going to surpass this range right here, or this volume imbalance. It has to fill it up. Sorry, that. So we had to fill it up. Now we've currently filled up that fair value gap with the volume imbalance. Number three is that we created a liquidity sweep. So if we use this short-term high, I'll show you in the lower time frame what I basically mean with that short-term high. So at the moment, this was used as liquidity. Okay, so we currently have two order blocks that have been used within this range of today, which is Tuesday. All right, so let's go down to the 1 hour time frame to basically have a look at what currently happened or transpired in the markets as well. Bear in mind, we're using three time frames, okay? So these three time frames is going to be Asia, London, and New York. And these the template of New York, or sorry, the three templates is Asia creates the high and low of the day. The second one is going to be London creates a high and or low of the day. Third one is New York creates a high or low of the day. So currently we've used one of the templates, which is the London high and low of the day. But first, let me map out the structure. So this is the beginning of 30th. So we're currently looking at this particular day, right? So now when you look at Asia, Asia starts at 8 New York time and it finishes at midnight New York time. So if we map it out, it's just these 1, 2, 3, 4 candles. Okay, 4 hour candles. If this would just be one single candle on 4 hour time frame, but in this context, it's going to be 4 candles that have transpired. Okay, so what has currently happened within this range? So within this range, we've used the two kill zones, which is the London kill zone and the New York kill zone. London kill zone starts at 2 a.m. It finishes at 5 a.m. The second one is New York, which starts usually around 7 and it ends at about 10, because it's 3 hours per time span. Okay. Once Since we have had a quick run up of price action, on my end, what I understood is that since we had a price run on this, on the first run was from the mitigation of the 4 hour order block, we ran above short-term high. You see this wick here? Look at the sides of the wick. If you have a candle which has a high wick and two lower wicks on either side, that is a swing high. If you have a candle that has a lower wick which has two higher wick on other sides, that is a swing low. Same example here. Here's a high of the wick, the low wick, lower wick, higher wick. Now these three sequences are the so-called swing low. Okay. So remember what I said yesterday. I said that price action would basically run up, potentially run into the 4 hour order block, and also targeting this short-term high, which also is classified as liquidity. The reason why it's classified as liquidity is because it came into the fair value gap and the volume imbalance, it filled it in partially. So now what happens in price is that if there's a volume imbalance, price will come back to it. Sometimes it can come back after days, sometimes it comes back after months, sometimes it just comes back completely within that particular day. In this case, Tuesday came and played the role within that range. Just understand that now we have formulated a potential, I'm not saying it's official, a potential, but first let me map out the first weekly range. Okay, so the weekly range is right here. So this low, let me map this out. This low has been taken out. Let me just also copy this. Nope. I'm just going to copy this as well so that you will see what I'm talking about. And zoom it out. And we'll see first. Let me just check. This is Thursday, Friday, Monday, New York time, midnight. 0. Okay, so we currently have this weekly low, and this is the weekly high. Okay, so since we have this weekly high that has not been taken out, we could anticipate it coming back into that weekly high and taking out that weekly high, or we're going to continue with the order flow of the daily time frame, which is currently bearish at the moment. All right. So what happened today? Today was a beautiful, beautiful textbook setup, which is creating the London low of the day. The first thing I want to let you know is that we created a rejection of this order block right here. This little black candle right here is called an order block. Okay, this OB right here, 1 hour OB, 1 hour order block. When price came down, let me draw it on the 15-minute time frame so you guys can actually see it for yourself. What will happen with price is that whenever they reach a 4-hour order block, they will basically jump into that order block, and then price will rally back, and then it will continue in the direction that it was supposed to go, or reverse and then go the opposite direction. So on the 15-minute time frame, I just want to show you what really happened in price. We reached an order block, which you saw on the 1 hour. Price came in, but before we did that, we created first the Asian range. Right? Here's the Asian range, which is the high and the low of Asia. Okay? When we created that, we first targeted the bearish side of the market. Reason being is because we started taking out significant highs. This was the last high or swing high that caused this low to get taken out. So when that got taken out firsthand, it initiated the algorithm to say that, okay, now we are shifting price action into a bullish range. And what will happen sometimes is that price will create something like this, where it will first go down, pull back, come back down fully, and then it will break above, come back internally, and then it breaks above again, and then it takes out it sweeps out the low, this low, and then continue after that. That usually happens when price action basically sweeps a swing high before breaking it. What you need to also get to look into as well when you get the time to do so. And basically now when we look at price action in this case is we had imbalance right here. Remember when I said yesterday, when there's an imbalance, price will come back and fill it in. Reason why they have an imbalance is because there is there's one side of the market that gets fulfilled in terms of the orders, and also there's an influx and a transfer of money. And when there's a high volume of transfer of money, basically price will give you this idea right here. Again, this is my way of explaining it, but credits to ICT. He basically says this base is just an inefficiency in buyers and sellers. So one side of the market gets taken out, and then when that gets taken out, price will basically the objective behind it was that price would come back into an order block. So what they did was they used London as a projection, right? Meaning that institutional or the algorithm, the idea of the algorithm, which is basically creating a simple head and shoulder, what it did was it first created a consolidation for orders to get created in Asia. Price then took it out in London, whereby price will create a short-term high, pulls back internally, and then it continues higher to basically break the Asian high, which is what it did here, where it broke this Asian high, right? And then it came back to fill in some inefficiency into the range, and then it continues after that. Sometimes it can continue by breaking, or it can create something like this, where it reverses. So this could be an anticipation of something like this to play out for tomorrow. But the objective at the current moment was, or let's just say for today, we first took out sell side liquidity, which means that the stop losses that were sitting underneath Asian low is liquidity, which means it's the money that the guys who were selling were collecting. In my perspective, what I'm understanding from that concept, sell side liquidity is just money that is sitting as stop losses, which were initiated for buy orders. But then the guys who were selling used that as profit targets, or yeah, pretty much profit targets, so that the guys who had their stop losses would transfer money from the guys who were buying and use those stop losses at the Asian low to now liquidate those guys and make money out of those guys. That's sell side. And same applies to buy side liquidity, whereby stop losses and breakout traders would be sitting here, and when that stop loss gets hit, it means that now money is being transferred from the guys who lost that money to the guys who profited, whereby now it's called buy side liquidity. So it's just money that is being transferred from the guys who lost because of the stop loss, and it's transferred to the guys who use those stop losses as take profits. Now, since the idea of this structure was bullish, price swept. If price is bullish, I also want to let you know is that when price is bullish and price creates a pullback and it touches a support, supply, or order block, you anticipate the high and next high to get created. And when that higher high gets created, your target area could be that area, or it could be another significant high which has not been targeted as well, which also allows you to profit. So this is just a pretty much simple textbook idea whereby price will liquidate, market structure shift, fair value gap, mitigation of fair value gap, mitigation of order block, price runs, which is your entry point. Your entry point can be the fair value gap with a low being being your low, which is your stop loss area, and you target the Asian high or the previous day's high. Now that will depend on the risk to reward ratio, but if you're somebody who basically uses like sniper, we can basically jump into the 5 minute time frame and you'll be able to see what I basically mean. Same concept, we used liquidity, we took out some liquidity below this low right here. We came back, we rallied above this short-term high and this high as well. Now, this is a different concept, but it's more or less the same idea because it's still creating a V shape before price runs to a higher high. In this case, what the algorithm did was it used this order block because it was not fulfilled and price broke above the 15-minute time frame or high. It came back into this order block because this black candle right here, which is that bearish candle before the impulsive move, it came back and mitigated it already. Also talk like putting it in 3 times. Now, also want to for you to know is that price or the bankers have so much liquidity. I'm sure you'll hear this everywhere. You'll hear this everywhere, whether you in my channel, someone else's channel, whatever it is. Price will basically touch a level 3 times. It's not every time they do this, but price will basically touch once, twice, and 3 times, and then they run out. Reason why they do that is because they are fulfilling the orders, but in brackets. Remember, these guys have order books worth $1 billion, sometimes hundreds of millions of dollars. So this entry right here, and bear in mind, this is just a smaller time frame. However, they sometimes use these time frames using algorithms of their own to basically enter these positions. Because remember, these niggas control this idea of price. Now, the main concept is just using a head and shoulder idea is now placed in different names. However, as long as you use the head and shoulder in the right context, you will be able to get the right content. Hope that understood. But yeah, something along those lines. What happened? Order block created, price rallied, price came back into that area, taking out this green candle, creating a market structure shift internally, coming back again, liquidity sweep. Let me remove this guy. We created another liquidity sweep in here, mitigated order block, market structure shift, price comes back again, and then it rallies after that. This is the 15-minute fair value gap. Here's a 5-minute fair value gap, same concept, liquidity sweep, order block mitigation of the 15-minute time frame, price creates a market structure shift, and then it just rallies above. Should it come back, it'll come back to this order block right here. If it has already these two candles, then we've already fulfilled the purpose of mitigating the order block, and then price would basically rally, which is what currently happened right there. Price came back into these two candles, which is the 15-minute order block. Price came in, it reversed back, and then it will come back again at a later stage, whether to either take this low out or to just basically sweep it, come deeper into this order block, and reverse back up again. But also understand that you will find that sometimes you'll have these candles as well, which also indicate that there's going to be a liquidity sweep coming, meaning that those lows are going to get taken out at some point, depending on the order flow of the market. So that basically does it for you guys as well. Excuse me. I'll basically do another recap of what happened in the later stages. In this case, New York basically came in and it basically just tapped into this area right, well, basically this whole range right here. It tapped into it and then it rallied. Reason being is because there's basically a I forgot what overlapping. Yes, there's an overlapping sequence whereby there is a fair value gap, which was here. Okay, there's an FVG mixed with a high, a swing high that was taken out. So price basically came through and fulfilled the orders and also took out anybody who wanted to basically put their stop losses right below this area and rallied above. Reason being to seek fair value, meaning that they wanted to close the value and start looking for liquidity. Remember, external liquidity, internal liquidity, external liquidity, internal liquidity. When they ran out external liquidity, they rallied above, they came back for internal liquidity, which is that fair value gap and that high, that swing high right there, to now target the next external liquidity, to now come back to target internal liquidity because we're still within this range. Internal liquidity to maybe target another external liquidity as well. You basically look at the fact that price came in for internal liquidity at a higher time frame to target external liquidity to come back to internal liquidity, which is this FBG right here, to now start targeting external liquidity. Potentially, they could run down to this level and then continue either up, or they're going to continue further down. By the looks of things, what I would say is two things that can happen tomorrow, and that will be, the first one is mitigation of this guy. Let me just say unmitigated. So there's going to be this jump into this price action where they will just rally above this short-term high into the fair value gap, do just a short-term pullback because they want to generate a bit of liquidity right here to let the sellers think that we're going to be selling, to basically rally into this OB to maybe target this extreme low. Or another idea is that they would basically jump in, come back down, and then continue above to target this order block right here, to target this OB right here, because that OB might be mitigated by this candle, but the actual green candle has not been tapped into, and then maybe further rally above it and then take it out after that. So that basically settles up everything. This was just the textbook London low of the day with uh, New York high of the day, low of the day London, high of the day New York. Sometimes this range right here basically closes above New York's kill zone, which is London close. So this was just the textbook, same thing that applied here, which was the day before, where London created the high of the day and price closed around the 10:11 mark using New York time. All right, so that hope that settles it, guys. Hope you guys get to enjoy this video. Stay tuned for the next one tomorrow, and thank you for watching until the end. Take care.